All right, y'all, this is Carter, and this is going to be the first video in about a 10 video lecture series on financial markets and investing. So this is the first video. It's going to be intro to businesses and financial markets. So first off, what is the point of a business? As we all probably know from all our consumption, the point of a business is to provide value to customers through either a good or service. It's crucial that a business is providing something that people want to buy. If no one wants to buy your good or service, then your business simply won't be able to operate for a long time. And if you're charging so much for your good or service that no one is willing to buy it for that price, the same thing, it won't be able to operate over time. So you need to provide a good or service that people want at a price that they will pay. That is the key to any business that needs to happen for the business to stay alive. But so through fulfilling this want or need, a business looks to create value as a whole for its investors. And by investors, it could be one person if you're just operating a business by yourself, or it could be millions of people if you are the manager for a publicly traded company. So what does this creating value mean? This kind of seems like a buzzword. What does it mean for a business to create value for its investors? So the key thing to know here is that the most important thing for any business is its cash flows. So for a business to create value, that just means that its future cash flows are increasing. So ideally, any business wants to have more money flow into its business than out of the business. That is what a cash flow is. If $30 is flowing out of my business, I'm buying something to sell, and then I sell that for $50 and that's flowing into the business, then I have a cash flow of 20. This is great. Having positive cash flows is crucial for any business. Not every business does have positive cash flows. Like an early stage tech company, they might be investing a lot into their software. So a lot of money is flowing out of the business and not much is flowing in yet, but they're hoping that over time, when people start to use their software, this will change. So it's crucial that at some point in a business's lifetime that they have cash flows and these are, sustainable. But the key thing here, the most important sentence in probably all of corporate finance, is that the value of a company or an asset is the present value of its future free cash flows. So you probably don't know what present value is or what future free cash flows means, but over time through this video series, I'm going to bring this sentence back up a lot, and hopefully by the end, you'll understand it to perfection. So I'm going to give a little lemonade stand example so you can better understand what cash flows are. So let's say I sell $50 of lemonade a day, and that the lemonade itself costs me $20 to make. And let's say I'm lazy, so I pay my brother $10 to operate the lemonade stand for me. So what is the daily cash flow of this business? So as you can see here, $30, the 20, to buy the lemonade, and then the 10 to give to my brother, that is flowing out of the business. But the $50 in sales is flowing into the business. So the cash flow is 50 minus 30. So overall cash flow is $20. And this is great. Having positive cash flows, love to see it. Any business loves this. But how do businesses get the money to start their operations? No business is immediately going to be able to just have positive cash flows immediately, because you need to invest things into a business. For instance, with my lemonade stand, I'm going to need to invest money to buy the table or invest money to buy the initial lemonade. You can't just start businesses out of thin air. So where do people, if they don't already have the money, because sometimes it costs millions of dollars to start a business, how do they get the money to be able to, invest in yourself? So if I wanted to invest in my lemonade stand by buying a table, a sign, and some supplies, I want to make sure that my business is going to do well. Where am I going to get this money from? Well, the answer to that is financial markets, and that's the key to this whole video. So financial markets facilitate the interaction between those who need capital, like my lemonade stand in this instance, and those with capital to invest. And for the sake of this video and simplicity, let's just say capital is money or cash invested and available to run a business. And a business needs to raise capital in order to get their operations off the ground, like I do for my lemonade stand, or to expand in some way. Like if I wanted to open more lemonade stands, I would probably need capital from other people if I didn't have enough myself. So why will investors give their capital to businesses? I mean, people don't just like to lose money. Well, the reason investors are willing to do this is that they do it in exchange for a return. So I might go to my friend Joe and be like, hey, Joe, I need $10 for my lemonade stand. I need $10 to get it off the ground. I say, if you give me $10, I will pay you $11 back in a month. And that means that he is getting his $10 back plus this $1 return. So he might think this investment is worth it for him. And financial markets, there are two types of financial markets. You have money markets and capital markets. So money markets, this is short-term lending and borrowing, typically less than a year. This is more low risk, and it's usually not that relevant to us as investors. It's usually used by governments and financial institutions to meet near-term obligations or regulatory requirements. One bank might go to another bank and be like, hey, I need $1 million for this regulatory requirement. I'll pay you back in 3 days. Trust me. Very low risk. The banks, governments, they typically trust each other, especially in the United States. But this money markets, this is just not as relevant to us. Low risk, not very high returns. Capital markets is more relevant. So capital markets, this is used for long-term investments. So a government or company might need to raise capital in order to fund long-term growth. So like my lemonade stand, if I wanted to get capital for it, I would need to go to the capital markets, not the money markets. So essentially, a company can raise capital through two main ways, either through debt or through equity. So debt financing, this is when a business borrows money from a creditor or lender, they mean the same thing, and then it repays them over time plus interest. So examples of this include a bank loan, like for a house or a car, or bonds, which I'll talk about later. And typically riskier debt has a higher interest rate. If my friend Joe thought I was, kind of irresponsible with my money, he might say, okay, Carter, I'll give you those $10 to start your lemonade stand, but you're gonna need to give me 15 back because that's kind of a risky investment for me. I'm going to talk a lot about this in my next video, which was more centered around investing. But the more risk you're taking on, the more reward you need to be compensated for that risk. And oftentimes with this debt financing, since it's pretty safe, banks don't want to make risky investments. They're securing the loan by a company's assets. So, for a house, if you go out and take a mortgage on a house, that loan is secured by your actual house. If you were to just stop paying your mortgage, the bank is going to foreclose on your house. So that's the collateral. In this case, for my business, the collateral might be the inventory. Joe might be like, okay, Carter, well, if you don't pay me back, I'm going to seize your inventory. So, that entices me even more to pay him back. So, my business can still run. And lenders receive no ownership in the business. This is key. And thus, they do not benefit much from a business improving. Banks, they kind of just have like two scenarios. Either they get paid back or they don't. And usually they're going to get paid back. So it's really, there's not like a ton of upside here, really. They're just trying to find small spreads that they can make money in. If someone gave a loan to Amazon in 1998, they're not going to have made that much money. It's different if someone bought Amazon stock, equity. So now let's talk about equity. Well, first example. So let's say I need money to buy decorations for my lemonade stand along with a new table. And let's say I want to take out a $100 loan from the bank with 5% annual interest payments. So I'm paying $5 a year. And this loan matures in 5 years. So what does this word mature mean? This just means like the loan ends and I have to pay back the principal, which is the initial amount I borrowed at the end of, that loan. So $100 is the principal, and I have to pay that back when the loan matures after 5 years. And the loan is secured by my inventory, the lemonade, so it's more safe for the bank. So yeah, the loan reaches its maturity at the end of these 5 years, and you can see here through this little timeline how the cash flows are working. So I'm getting $100 in year 0, and then I'm paying back 5 a year, and then at year 5, I'm giving them back the principal plus that last interest payment. So this is kind of the structure of loans. This is how they usually work. But there's a lot of other, weird loans or bonds that I'll get into in future videos that are a bit more abstract. So now let's talk about equity financing. So raising equity is the process of raising capital through selling a portion of the company. So this is like stocks. If you're buying stocks, you're buying a teeny little part of a company. Also private equity, which is, private investing. They'll buy like half of the company with equity. And that means that they now own that company and, they have a claim on its cash flows. I'm going to get more into that later. But let's say an example, if my lemonade stand is worth $500, but, if I'm, want a 1% stake in someone's company, how do I know how much that 1% stake is worth? How do we actually value businesses? I'm going to also get into this way more in future videos. But as I said, it's the projected present value of a business's future free cash flows. So if my future free cash flows are expected to be, the present value of them is expected to be $500, that means my business is worth $500 in the present value. So if I want to sell half my business, then I can raise $250 through equity financing by giving up half of my business. So now let's look at public versus private companies. So private companies, they do not have their debt and equity traded on public markets. And advantages to this are that they can stay in stealth mode and don't have to follow SEC regulations. So by stealth mode, I mean public companies have to report all their financials and kind of some of their strategy. And a company like Uber in 2014 or something like that, they might not want everyone to know what they're doing because they're trying to do something kind of innovative and they don't want a big company to steal their ideas. So that's kind of an advantage to staying private. And then SEC regulations, you have to follow a lot of rules, and it can be kind of annoying for managers if it's not necessary. So public companies issue shares of equity, so stocks, which we all know, and these are traded on public markets. So you and me can go on a public market and buy a share of Apple. That is a public corporation. And the advantages to this is that there's increased access to capital for the firm to reinvest, and there's more liquidity for owners. If I have a business that's worth a lot, I can, make my business public. And this is great because now I can liquidate my position and actually reap the rewards of my great company if I really want to. With a private company, it's harder. You have to manage a whole sell agreement. With a public company, it's very easy to get out of your company, which is great for some people, especially if they're old or something and they just want to exit at some point. The disadvantages are more public scrutiny and competition. As I said earlier, competition, bigger competitors going to be able to see exactly what you're doing, might be able to steal some of your ideas. And public scrutiny, you're gonna have to report everything. So if you're not paying your employees enough, people are definitely going to be aware of this, and you're going to get scrutinized by it. So let's define market capitalization, also known as equity value. So stock has shares, which is just basically one sliver of a business, tiny sliver typically. So the shares outstanding is the total number of shares that are being traded for a specific company. The share price is the dollar amount for one security. So for instance, Callaway, the golf company, shares are $25, and they probably have a ton of shares. So market cap is share price times shares outstanding. So this is one way to kind of value a company. In reality, we typically use enterprise value, which I have a video on and I'll talk about in future videos. But market cap is one easy way to be oh yeah, Apple, it's worth $2 billion or $2 trillion or whatever it's worth. But market cap reflects the perceived value based off of shareholder expectations. You might wonder, yeah, why do stocks change in price? What is that reflecting? Well, it's reflecting changes in shareholder expectations. But what does that mean? What expectations? Well, equity investors derive all value in the form of dividends or share buybacks. This is extremely important. They derive all value from this, and companies use their cash flows to do dividends or share buybacks. You can see cash flow is very important. Therefore, market cap is the expectations of a company's future cash flows, put simply. It's a bit more complicated than this. I'll go into it in future videos, but put simply, this is what market cap is reflecting. And you might be wondering, Carter, what about if the stock goes up? That's not a dividend or a share buyback. You also might be Carter, some companies Amazon, they don't really do dividends. How are you deriving value at all if a company doesn't do that? Well, investors make money through capital gains, which is the stock going up. People obviously make money through that. That's how a lot of institutions make money, by trading stocks and the value going up. But in most cases, this only happens because the company's future cash flows look to be more favorable. So the value of a stock definitely is indicative of how the underlying business is performing, in relation to its cash flows. If a business looks like it has a lot better opportunities and higher cash flows, of course the stock price is going to go up. And even companies like Amazon that don't pay out dividends, if we said, okay, Amazon, in 10 years, your company is over, it's just going to end. At the end of those 10 years, all of those cash flows after they met all their financial, obligations would be paid out to equity holders. So we kind of just have to make the assumption that at some point a business will pay out, dividends or share buybacks. So IPO, initial public offering, this is how a firm initially goes public. If they want their stocks to be traded, if they want to get all this capital, which I talked about earlier. So when a company goes public by offering its shares, they do this and it gets bought on an exchange. And exchanges include the New York Stock Exchange and the NASDAQ. NASDAQ is typically more tech stock companies, and New York Stock Exchange is the oldest stock exchange. Everyone knows about that. So for instance, stock might trade on the New York Stock Exchange, and you go to that exchange, or you go to another, person that can operate the exchange, and you can buy a share of that stock. And also, just to be clear, it is a public corporation. If a corporation goes public, it is now their fiduciary duty to maximize shareholder value. If I operate a business by myself, I don't really have like a fiduciary duty to anyone besides just like following all laws, But if I go public, like I'm not allowed to do things like just like pay myself like $1 billion salary. Like I'm supposed to be maximizing shareholder value. So you might be wondering, Carter, what about, managers? How are they incentivized to actually do that? Well, typically managers will also own a lot of their own stocks. They're incentivized to do this. And they want to keep their job by making the shareholders happy. They're basically like the shareholders and the board of directors, which is a lot of people that, own the shares. They like kind of are the boss of this manager. So the manager wants to, help them by, producing value for the shareholders. So it's a public corporation's fiduciary duty to maximize shareholder value. This is important. Just wanted to clarify. And let's talk about debt for public companies. We talked about equity, which is just stocks, which you make public by IPOing. What about debt? So while a company can still get a loan from a financial institution that isn't really traded on public markets, it can also issue bonds, which are traded on public markets. So bonds function like a loan exactly. They have the same principle, interest payments, which you call coupon payments, same thing, coupon payments, interest payments. And then, the principal gets paid back at maturity. So bonds are very similar to loans, except there's a lot of different investors. Just like when a firm IPOs, a lot of people will buy those shares. A lot of people might buy bonds. They might be, in essence, giving that company capital so that, bonds are way more liquid than loans as well. Like a loan, like I can just sell my bond like a public market, like easily, where if a bank has like a $2 million loan, it's kind of hard for them to go sell that to someone else. So also like stocks, bonds fluctuate in price depending on how likely it is that the borrowers of the business will pay them back. If a business is doing really poorly, their cash flows aren't great, then the bond's price might trade down because there's more risk in holding that bond. So it also kind of reflects overall expectations for how the underlying business is performing. So let's talk about primary versus secondary markets. This is a key thing too. When a company initially issues equity or debt, it is sold on primary markets. This company goes to the primary markets. They're like, hey, I'm giving you this sliver of my company, buy it. But when you and me are just trading stocks, it's not always Apple selling me a piece of their business, or else there just be like unlimited pieces of the business. Like this doesn't make sense. What happens is we're trading stocks on secondary markets with other people that previously owned the stock. So the business itself, like Apple here, is not directly receiving capital from these transactions. If I go buy a share of Apple from my friend, Apple's not getting any money from that. So that begs the question, why does Apple even really care about its stock price? I mean, why does the manager, why do they care? Well, one, to keep their jobs, but also, it's their fiduciary duty. But more so, like the stock price reflects how they're doing, their cash flow. So business, like it's, validating to them if their stock price is going up. Oh yeah, my cash flows are good. Also, if a business wants to, raise more equity in the future, they want to like sell, they could like dilute, which means like the current, equity holders might, own a little bit less so they could sell more. Then if they have a high stock price, if the value of the business is deemed to be a lot, then they'll be able to raise more capital. If a business's stock price is trading at like 2 cents, that basically means people think the business is like worthless, and they're definitely not going to be able to go to the public markets and be like, hey, buy some more of my equity, because they're deeming the business to be worthless. So that's why, manager, they would care about their stock price, even though these secondary markets, which, are affecting the stock price, it isn't actually, affecting them directly. So let's like review now. Why are cash flows so important? So I didn't really say this, but a business can use its cash flows to do 3 things. This is very important. They can use it to pay off debt, pay equity holders in the form of dividends or share buybacks, or reinvest in their business. So having cash flows is just essential for a business to continue to grow, meet its financial requirements like debt, and satisfy equity holders. So this makes sense. But what about a stock that they don't do dividends or share buybacks? I said this earlier. This just means that the company, like for instance, Amazon, they're like, we're not going to give dividends. We're just going to reinvest all that money back into the business. But you need to trust us. We're so good at reinvesting our money back into the business that it's going to produce more cash flows for you, over the long run. So, really a business should only be, reinvesting in its business if equity holders can derive more value out of that investment over time than if they were just to get the dividend or share buyback now. That's an important thing. Businesses don't always do that. So that's a bad sign if your business doesn't give out dividends and they're just making poor investments into the company. They're essentially like stealing your money, not really, but like essentially you would really just want them to give you the dividends. But that's why that works. And that's why, stocks that don't do dividends or share buybacks, like they still have value. A question I was once asked in an interview, they were like, okay, Carter, if you invest in equity and they tell you that they're always going to reinvest into the business over the time forever, you're never going to be paid back, what is that equity worth to you? The answer there is it's worth zero to me. The investment only has value to me if I know that these cash flows eventually in the long run will eventually flow to me in the form of dividends or share buybacks. If they're never going to do these things, the stock is worth nothing. Obviously, in practice, business will eventually always do dividend or share buyback, but that's kind of just the theory behind it. So in conclusion, businesses need financial markets to have access to capital to fund and grow their operations. And these investors or banks are willing to invest their money, to give these businesses or governments capital for a certain return. So my next video is going to be a lot about these returns and the kind of assets that, investors can invest in. And lastly, cash flows are very important for business for the reasons, I laid out. Businesses, it's very important for them to have cash flows. If they have positive cash flows, they can use those to reinvest in the business, pay off debt, or give it to equity holders. If a business has negative cash flows, they're not really going to be able to, they're definitely not going to be able to give out dividends or buybacks. They're not really going to be able to invest as much in the business that they would like to, and they might struggle to pay off their debt over time. So that's why cash flows are important. I appreciate y'all watching the video, and make sure to watch the next one. Thank y'all.